Ladies and gentlemen, good day and welcome to Sangam India Limited Q2FY26 earnings conference call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Garima Singla from Go India Advisors. Please go ahead. Thank you and over to you, ma'am.
Thank you. Good afternoon, everyone. I'm Garima Singla and it's my pleasure to welcome you on behalf of Sangam India Limited. Thank you for joining us today for the Q2 Financial Year 26 earnings call. This call is being hosted by Go India Advisors. Please note that today's discussion may include certain forward-looking statements. Therefore, they must be viewed in conjunction with the risks that the company faces. Today on the call, we are joined by Mr. Anurag Soni, the Managing Director. I now invite Mr. Anurag Soni to present the company's business outlook and performance, after which we will open the floor for Q&A. Thank you and over to you, sir.
Hello. Good afternoon, everyone, and a warm welcome to Sangam India Limited's Q2 FY26 earnings call. Thank you for joining us today and for your continued interest in the company. Our results and earning presentations have been uploaded on the exchanges, and I hope you've had the opportunity to go through them. The second quarter reflects a steady progress and operational discipline as we continue to strengthen Sangam's foundation across all businesses. Even in a mixed external environment, we have seen healthy demand in our key segments supported by our integrated model and focus on efficiency. In Q2, our revenue stood at 785 crores, reflecting a 16% year-on-year growth, driven by higher volumes and an improved product mix. EBITDA has increased by 32% year-on-year to 76 crores, with margins expanding by 120 basis points to 9.6%, underscoring improved cost control, operational efficiencies, and better realizations. Net profit for the quarter was 23 crores, reflecting the strength of our operating performance. During the quarter, the board has also approved a revision in the company's depreciation policy to align the estimated useful lives of assets with their actual economic life and industry benchmarks. This change is supported by an independent technical evaluation and provides a fairer representation of our profitability without any impact on cash flows. Looking ahead, our focus remains on building a stronger, more efficient and profitable business. We are taking measured steps to enhance productivity, reduce costs and maximize the share of high margin and profitable products across our portfolio. At the same time, we continue to strengthen our sustainability framework by improving energy efficiency, expanding renewable sourcing of energy, and increasing the use of recycled materials in manufacturing. These efforts are aimed at improving long-term profitability while ensuring that growth remains responsible and value accretive for all stakeholders. With that, I would like to conclude my remarks and open the floor for your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Raman KV from Sequent Investments. Please go ahead.
Hi, sir. Can you hear me?
Yes, please go ahead.
Yes, sir. So my first question is, I just want to understand, in the opening commentary, you mentioned the two things. One was the growth was led by higher volume growth as well as better product mix. Can you elaborate the second part of it, better product mix, in terms of how the products mix helped in one revenue growth? Second is, can you also throw light on the realization which helped during the quarter, which helped in margin expansion?
Right. Thank you for your question. So the company actually gone through extensive capex cycle over the last couple of years, and we've kind of completed at the end of that cycle. So all the capacities are up and running as on date. So that has enabled us on the volume growth And also, if you on our presentation, you will see that capacity utilizations have gone up across all our verticals. So that is actually enabling us on the growth for the sales. And as far as the product mix is concerned, so that is a continuous process. You're always looking for producing those products which are yielding higher margins, and maybe producing those products lesser which are not so profitable. So that is a continuous process. There's nothing that I have to add on that any particular product that is leading to this. It is the overall business, and across all the verticals we are working on the product mix that is enabling the growth. Thank you.
And sir, with respect to the realizations?
So realizations, I think again, if you see the on a quarterly basis, the prices of our key raw materials, or even for example cotton fiber and the yarn side, they've been on a declining trend for about 8 to 10 quarters now continuously. So we see that has bottomed out, and probably there's some uptick on that front. So that's why the realizations are getting better. Basically the downward cycle has bottomed out. So that's what is enabling better realizations.
So you're basically saying the yarn prices have bottomed out?
Yes, that is correct.
So if you don't mind, can you just give the yarn prices during the quarter Q2 versus Q1 and the cotton prices also?
Just 1 second. Q2 versus Q1 yarn prices.
Thank you. The next question is from the line of Kunjal Agarwal from Aryan Capital. Please go ahead.
Thank you so much for the opportunity. So I wanted to ask that for this quarter, the PAT is up for 317%, and it looks impressive. But how much of that is sustainable versus driven by one-offs or base effect?
Thank you very much for your question. So I'll just update on the last question. I was just looking at the data on the yarn prices. So about Q1 to Q2, there's about a 2 to 3% increase in the prices. That is to answer the question earlier. Sorry. Your question regarding the PAT margins. So the current quarter reflects the one-time impact of the change in depreciation policy. How sustainable it is going forward? We feel that currently, I think if you see our EBITDA margins are expanding over the last 4 quarters. If you see, we are growing on the EBITDA margin front. I do feel that even going forward that should continue. So this one-time gain of depreciation may be offset by the growth in EBITDA margins. So we do feel that this is a sustainable number. So in the coming at least the second half of the year, I do feel that this PAT should be sustained.
Okay. And so gross margin, when we see that has also expanded sharply. So how much comes from the lower raw material cost versus operating leverage versus the product mix?
See, it's a mix of everything. Gross margin, it's difficult to actually point out that it is due to a particular cost coming down, or because see, we are consolidating 3 or 4 verticals. That's the denim business, the cotton yarn business, PV yarn business, synthetic fabric business. So I would say that the margin expansion is an effort of all the factors that the company is working on, and majorly the capex cycle being completed. So today our the capacity utilization is higher, and also all the new machines that we've the new capex that is coming in the company, I think that is more cost efficient compared to the older plant and machinery. So all that is factoring the margin expansion.
Okay. And my last question would be, sir, that the textile division margin has been volatile. So how do you see the spread between cotton and blended yarn trending in H2?
I think it has been stable for some time now. As I said, that the prices on the downward cycle have bottomed out. So I do feel that the margins that we are reporting today, I think that's a sustainable number. I think we should see a couple of points going up from here in the coming quarters again.
Okay. That's it from my side, sir. Thank you so much.
Thank you. The next question is from the line of Dipesh Sancheti from Manya Finance. Please go ahead.
Hi, am I audible?
Yes, you are.
Yeah. Are you seeing any pricing pressure from the Chinese or the Bangladeshi suppliers in your key export markets?
No, I don't think so. Bangladesh is actually a big market for us. So, no, to answer your question, on the competition front, no, we don't face any pricing pressure from Bangladesh. So we are actually exporting a lot of yarn and our denim fabrics to Bangladesh. That's actually one of our customers, not the competitor.
Okay. And what about the American market? How much is your exposure on the American market of the total sales?
So American market is probably, I think, about less than 1% of our total sales comes from the U.S. market. So, and we've also put up a slide on our presentation, the investor presentation, showcasing that we are not, as a company, we're not very affected by any kind of the tariffs from the U.S. markets.
No, not even indirectly, because you in your clientele you have Walmart as well as a lot of American clients also. So, I mean, even the customers whom you are supplying in India and they are giving to America, I mean, they are exporting. Even that is not affected? So,
for a lot of these clients, actually, goods get shipped via Bangladesh or via a couple of African nations. So, there the tariffs are pretty competitive. So, no, to answer your question, for our business, we are not really affected by the American market, directly or indirectly.
Great. Okay. And given the volatile raw cotton scenario, how are you securing consistent quality and pricing?
Well, that is the nature of the business with regards to the cotton pricing movements. So we do from time to time when we do feel that the cotton prices are probably low, there is some stocking that we do, or there's also always some kind of order book always in place. So at best, any kind of cycle affects us for maybe a month or two. Any kind of further movement gets factored in either yarn prices or on the raw material side. So at best, I think 30 to 45 days risk is something that we may carry. Otherwise, no, the prices on either side take care of themselves.
Okay. And what is the cost of debt right now?
So the cost of debt it's roughly around 6.75, below 7%.
Below 7%. Now, I was going through your ROE. So ROE is below your cost of debt also. Now, how do you actually, because, so, I mean, if you say, I mean, the ROE is significantly below the cost of debt also. So how are we managing the entire aspect, and where do you see going forward? What is your target for the ROE to come?
See, the ROE is low because the PAT margins have been low for a period of time now. However, last couple of quarters there's an uptick on the absolute EBITDA number, and subsequently PAT has started going up, and we do see that margin to sustain going forward. So I think ROE will take care of itself. I'm not much worried about the low ROE today. I think that is in the past now.
Because even the kind of PAT margins and PAT you have shown is mainly because of your depreciation policy being changed. Now, going forward, we see the same depreciation policy, so your PAT numbers will be similar to what you have shown?
In the current quarter, there is a one-time impact of about, I think, 9 crore on the PAT from the previous quarter. But as I mentioned earlier on the call, I think we do see expansion of about up to a couple of points on the EBITDA margins over the next, in the current quarter and then probably the March quarter. So I think the PAT margin will not go down from here.
Because historically your depreciation was always in the range of around 28 crores to 30 crores. Okay. This time the depreciation has come to around 10 crores. Your PAT net profit I see is 23 crores. So if I just do the simple math of 20 crores being saved on your depreciation and that shifting to the PAT, to the net profit margin, I mean, then it leaves me around at 3 crores of net profit. Would that be a fair assessment that 20 crores out of the 23 crores, 20 crores has actually come from the depreciation?
No, that will not be a fair assessment because you have to factor in the tax impact also on that. So if we see this, that depreciation
if I see the tax impact also, then also it will be around 15 crores.
Right. So as I mentioned again, that because of the depreciation one-time gain of about 9 crores from the previous quarter, that will not come in the current quarter now. But I do see we'll add something on the EBITDA, and that will take care of the one-time gain that has come in the quarter. So let us say if EBITDA is improving by 1%, that adds about 8 crores to the margins again. So we do see at least a expansion possibility of 1 to 2% in the current quarter and the next quarter coming in.
Now, my last question actually. What is the reason of changing the depreciation policy? Effectively, you're paying more tax, okay, and your cash profit. It's affecting your cash profit rather than keeping it as a depreciation and having more cash into the company. We are actually giving that extra cash to the tax department. Wanted your views on it.
No, so as I mentioned in my opening statements, it is just a fairer representation of our profitability, and it has zero cash flow impact because tax calculation from income tax point of view, depreciation calculation is a different calculation versus the calculation on the books of accounts. So that difference will remain. So there is no cash outflow on the tax front.
Okay, so according to you, there is no additional cash outflow on the tax front?
No, there's nothing on that front.
Okay, fine. If there are any other questions, I'll just follow you back. Thank you.
Sure.
Thank you. A reminder to all participants, you may press star and 1 to ask a question on your touchtone telephone. The next question is from the line of Disha from Sapphire Capital. Please go ahead.
Hello.
Yes.
Hello. Hope I'm audible, sir.
Yes, you are audible, please.
Yeah, thanks a lot for the opportunity. So, sir, as you mentioned that we've been going through an extensive CAPEX cycle, and since now all our capacities are up and running, so how much revenue growth do you forecast for this year?
I think we are on a run rate of about 16% revenue growth for the half year ended September.
Yeah.
I think that should continue for the full year. And so we do expect to grow anywhere between 12 to 15% on the revenue front.
Sorry, sir, I couldn't get you.
So we do expect to grow over about 12 to 15% on the revenue front.
All right. And so your export share is currently, with this quarter, is around 37%. Do we expect this percentage of revenue to, this percentage of exports to continue, or do we want to increase it further? What's the target?
If you see our historical data, our exports actually range anywhere between 35 to 40%. That is where we've been historically. I think that is the number that will remain even in the future. I don't see any significant change on that front.
Yeah, so around 40% is something that we can expect.
Yeah. So, yeah.
All right. Thank you. That'll be all.
Thank you. The next question is from the line of Nikhil Porwal from Perpetual Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on, so the gross block has, you've done an extensive capex moving from 900 crores odd in gross block to almost 1800 crores closing FY25. So in general, in terms of capital allocation, what kind of payback do you all expect on this capex?
What kind of payback do we expect on the...
Yes, so in years, when I'm asking that in terms of years, in how many years do you all expect to recoup this capex?
So normally in our industry, whatever capex we do is planned around anywhere between 5 to 7 years of payback.
Okay.
Yeah.
And in the current presentation, you are reporting 4 divisions. The capacity utilization for 3 of them is almost at optimal level or close to full capacity, while garment is the one where the utilization is lower. So how do you plan to scale this up? And are there any further levers for these other divisions where the growth can come maybe via additional capex or change in product mix?
Right, thank you. See, our yarn division is basically about 90% plus. I think there is another scope of 4-5% capacity utilization there. On the fabric front, both denim and the PV fabric divisions, I think there is still scope of about 10-15% addition in capacity utilization. On the garment front, if you see, the capacity utilization was actually falling prior to this quarter continuously over 4 quarters. This is actually the first quarter where we have increased our utilization. So from 25%, we've gone up to 35%. I think there's a substantial scope of improving the utilization here, and we have a decent order book in place today that we've worked upon over the last 6 months. And I do feel that these capacity utilizations should touch about 60-65% maybe by next quarter.
Okay. That's just a general observation. So while the capacity utilization has improved on a Q-on-Q basis, it doesn't reflect in the top line.
So on the top line, if you see, I think what might change is on the capacity utilization front. In our results, I think that there is a purchase of stock and trade. So last quarter, there is a trading income of about close to 70 crores, and there's a difference of 50 crores there on the trading income in the current quarter. So that does not reflect on the capacity utilization in the previous quarter. That's why we see the capacity utilization getting better, but does not reflect on the overall revenue.
Okay, so the like-to-like comparison is probably a 720 odd crores in Q1 versus 786.
Right.
Okay. One question is on, so can you explain a bit about the difference in margin profile of these 4 divisions and also the asset turn and working capital cycle in all these 4 businesses? Just want to understand how can that change over the next few years with higher utilization.
Right. See, I think as far as the margin is concerned, the overall company margin is about 9.5-10% for the quarter, so close to 10%. The range between the different businesses would be anywhere between 8 to 12%. So on the EBITDA margins. As far as the working capital question is concerned, on the yarn side, the working capital involvement is lower. As you move up the chain, both on the inventory side and the receivable side, the working capital requirement gets more than the raw material side. So I would say that I think about 30 to 45 days of additional working capital is required for the fabric division compared to the yarn division.
Okay, and so the assumption is you are talking about 12% margin, which is primarily in the garment division, because the rest of them are like a feedstock to it.
Right. So you can say that, as I mentioned, that about whatever the company average is, between 8 to 12 is where all the divisions land.
Okay. One last question is on so export versus domestic split. Why does this matter? Is the margin profile different for both for exports, is it higher versus domestic?
That's not necessarily true. I think margins are similar either on the domestic or the export side. It is just a representation given in the presentation that this is the export, this much revenue comes from the export. However, for us as a business, it does not really matter.
Okay, got it. Thank you.
Thank you.
Thank you. The next question is on the line of Rohit Ohri from Progressive Shares PMS. Please go ahead.
Hi, Anurag, Dakiraji, if you are there on the call. Sir, a couple of questions from my side. The first one being the 12 megawatt captive renewable power tie-up that we have in Rajasthan, which is expected to be completed soon. What is the savings that you expect in rupee term or maybe on quarterly basis?
So, with this 12 megawatt, the annual projected saving is about 10 crores. This is supposed to start our power consumption. The delivery will start from the month of December itself.
Anurag, if you can share the current price for electricity that we pay in the state of Rajasthan currently.
Currently, with the new tariff in place, I think the tariff is anywhere around 8.25 to 8.5 rupees for the power from the grid.
Okay. My next question is that in this current cycle of maybe 2-3 years of probably growing textile industry, do you think that you will be able to reduce the debt to probably half and give a booster to the return ratios, maybe the return on equity, which will happen on its own, and the return on capital employed?
See, our debt repayments are about 120 crores annually. So let us say you did mention over a 2-year period, right?
3 years, yeah, that's okay.
Over a 3-year period, we may be able to reduce debt by about 350 crores. That is assuming that no new capex comes in. We've gone through a heavy extensive capex cycle, so there is nothing in plan in the near future. But as you would know that in manufacturing and once capacity relations ramp up and margins are in place, the only scope of growth that can come in is via further expansions. So that is something that a cycle will always remain. However, it will not be as extensive as we have incurred in the last couple of years. So, to answer your question, I would not commit on the 50% debt levels from today. However, there is not anything major planned, at least over the next 12 to 18 months on the capex side. We want to first build on what we've already incurred and maximize the profitability on that.
True. So do you think that you'll try to reach somewhere like 12% or maybe 14% kind of ROC in next 3 years or so?
Yeah, I think ROC next 3 years, no, that will be a longer time. I think probably we may be able to reach that number maybe, I think 12 to 18 months time.
Okay. Secondly, on this completion of the capex, do you think by FY28-29 you'll reach a top line of maybe 4,000 crore with sustainable margins of maybe 14-15% kind of a range, EBITDA margins?
I do feel, I think this year we are on track to do about 30 to 3,300 crores of top line. So I think about 12 to 15% growth annually, that may take us close to the number you're mentioning.
Okay. A few more questions that are related to the technology automation which you mentioned in the opening remarks and all the smart manufacturing or digital integrations that are happening. What sort of payback period do you expect from these initiatives, and do you anticipate any decrease in the employee cost or maybe in the headcounts going forward due to automation?
See, I think paybacks, I had already mentioned on the capex incurred earlier in the textile industry. I think we are looking at paybacks anywhere between 5 to 7 years of time. However, any kind of automation or modernizations, that we may incur going forward, I think we are looking at a shorter time duration now, that anything that we take up would be, that's anywhere between 3 to 4 year paybacks is something that we would probably evaluate. However, having said that, there's nothing big on the table as on date. There may be small changes here or there that may keep coming up, but nothing major.
And how much do you intend to spend on this maintenance capex or the upgrades on a yearly basis?
I think on a gross block of our size, maybe we may expect anywhere between 50 to 70 crores of modernization capex or maintenance capex as we may put. That is something that will keep ongoing. Yeah.
Okay. I have some more questions. I'll fall back in the queue. Thank you.
Sure.
Thank you. The next question is on the line of Saranj Gupta from Swan Investments. Please go ahead.
Thank you, sir, for the opportunity. I went a bit, so sorry, the questions are a bit repetitive. I have a few questions. So, like our yarn realizations have improved. So, is this because of the demand or inventory normalization?
See, there is not much if we are talking about any kind of market tailwinds, the answer would be no, that there is not much movement from the markets. Whatever improvements in the margins have come in is due to the capacity being utilized better at our end.
Okay, but can we expect the optimal utilization to be going ahead?
I think this is a number that we can benchmark what we've done in the current quarter, and we'll improve from here. So I had mentioned in the call earlier that yarn, I think there's another possibility of improving by 3 to 5%. On the fabric and denim side, I think there is still a scope of 10 to 12% improvement on the utilization. And garment, there's a substantial possibility.
Okay. So my second question is that are we hearing any news on the import duty that has been extended till on cotton that has been extended till 31st December? Like, is there any news on that, or are we listening anything?
Right. No, there's no further update on that. So currently, as we stand, the duty is exempted until the 31st of December.
Okay. So my last question is, what is our mix for cotton in like imports, and how much do we source locally? That's my last question.
See, normally the share of imports in our consumption is very low. However, for this current period of time, because the cotton crop comes in actually from the October month onwards, the new crop. So for currently we are about 30-35% on imported cotton and balance on domestic cotton. But historically, majorly what we use is domestic cotton.
So, like historically, what would be the sustainable number like we can look forward?
On consumption of import versus domestic cotton?
Correct.
Well, it may remain around the levels today. See, it depends on what kind of product we are making. So that there is some kind of yarns for that we need cotton to be imported. So this will be a dynamic number. Hard to say what is it that we can expect.
Okay, so I have a few more questions. I'll just join back with you.
Sure.
Thank you. A reminder to all participants, you may press star and 1 to ask a question on your touchtone telephone. The next question is from the line of Meet from Mahavir Enterprise. Please go ahead.
Hello, am I audible?
Yes, you are.
Hi, thanks for the opportunity. So, my question is on the long-term sustainable margins for our company. So, first of all, what we envisage in terms of sustainable EBITDA margins, and as a long-term shareholder, it is important for me to understand how are we going to fund the further capex, if at all we are going to do. I just wanted to understand the terminal value of our company and what the company is thinking in terms of long-term That's my first question.
Sorry, what was the last part? Long term?
Long-term value for the shareholders. I just wanted to understand the terminal value of our company. So how are we envisaging the growth of our company going forward for at least 2 to 3 years?
So I think what I would say that on the revenue front, I'd answered this that about 12 to 15% growth is something that we can expect over the next couple of years. And on the margin front, again, there's a scope of improving about two at least a couple of points on the margin. So what we are at 10 today, we'll see about improving by to 11 to 12% by maybe in a couple of quarters.
Okay. And what is the ideal capacity utilization for our company to achieve the mentioned turnover 4,000 crores, which you have already mentioned?
At what utilization levels that will come in?
Yes.
That would be about 90% utilization.
Okay. And so with power and fuel costs moderating industry-wide, why haven't we seen sharper improvement in our EBITDA margins? So can you throw some light on that?
So the power costs, sorry, actually, you were not clearly audible. What I could understand is you're asking about reducing power costs and what that will...
Yeah.
Fuel cost. Okay.
How much that will bring to our EBITDA margin?
So we are working on going as much renewable as possible. We've already done a captive power purchase agreement for about 12 megawatts with a developer that will come in from December, and we see annual savings about 10 crores from that front. There are further work that is going on this front, and I'll probably have something more to share over the next quarter. That the target is to get about 70-75% renewable from about 15% where we are today. So over the next probably 15 to 18 months, that is what the company is envisaging.
Okay. And sir, do you see any pricing pressure from other domestic peers? As many companies are expanding and doing capex in textiles, so how do you see the supply side dominance going forward? Or do you see any pricing pressure against your peers?
So there was a big capex cycle in textile. Probably, I think today, as we speak, there is not much capacity is getting added. So I think we are well placed on that front. No, I don't see any much pressure from our peers on the pricing front.
Okay. And sir, any markdowns or inventory adjustments carried into Q3 that could distort current quarter profitability?
Nothing substantial. I think this is something that always keeps on going in a business of our nature. So there will be some kind of inventory that gets stuck that you have to liquidate at lower prices, but no, nothing substantial.
Okay. And sir, one last question. Do you see any macros which could negatively affect our margins or put pressure on our capacity utilization?
No, as on date, I don't foresee any such challenges or risk in the near future.
Okay. Thank you, and best wishes.
Thank you.
Thank you. The next question is from the line of Manoj Jetwa from KSA Securities. Please go ahead.
Hello. Good afternoon.
Good afternoon.
Good afternoon, and set of numbers, and thank you for giving me an opportunity. So my first question is relating to the European US markets. So how do you see the rebound in both the markets? Any thought process on that, sir, please?
The U.S. markets currently, as an industry, as a company, as I had mentioned earlier, that we are not much affected by the tariffs. However, as a textile industry, the apparel side, whatever business was happening in the U.S. is challenged today because of the tariffs. 50% is a big number. So unless there's something happens on that front at the government level, I would say that there will be challenges remaining for the textile garment business. However, on the European side, I think business is growing there as far as India is concerned. We don't do much garments, So I would not be in a position to actually answer much in detail, but I do feel that our buyers, the fabrics or yarns that we are selling to, I think European side, they are more hopeful than the US business.
So my second question is pertaining to the asset turnover for the new assets which we have added in the recent capex we have done it so far, sir.
Mm-hmm.
What could be the asset turnover from that?
Asset turnover would be... what would that yield to our overall revenue of the company? Is that what you're trying to ask?
No. Asset turnover of the new capex which we have done it, sir.
No, I don't think that's what I'm asking. So asset turnover...
okay.
Yeah, no, I'm not. I don't have that data ready with me, so I'll have to check on that.
Okay. Thank you very much.
Right. Thank you.
Thank you. Due to time constant, that was the last question for today's conference. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Well, thank you everyone for joining us today and for your continued engagement with Sangam. We appreciate your time and interest in understanding our performance and future direction. As we move forward, our focus will remain on operational excellence, disciplined capital allocation, and sustainable profitability. We are confident that the actions we are taking today will position Sangam for stronger, more stable growth in the years ahead. If there are any further questions, please reach out to our investor relations partners at Go India Advisors. Thank you once again and have a great day.
On behalf of Go India Advisors LLP, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.